Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 30th. Following the RBA policy shift, the market started thinking, who's next? With the RBA meeting next week, Australia is the obvious candidate. The Aussie dollar fell sharply as a result. Note that Denmark also eased further yesterday, even though its rates are already in negative territory. This shows the pressure on central banks to ease as their counterparts elsewhere do so. I think that even if the RBA doesn't ease, it's likely to shift to an easing bias, much as the RBNZ did, and that alone should be enough to weaken the currency further. The Aussie dollar wasn't the worst performing G10 currency overnight, though. That honor went to the Swiss franc. Euro Swiss in particular jumped 1.7%. Perhaps people feel that the decline in Euro Swiss went too far. Perhaps the Swiss National Bank's covertly intervening. In any case, it looks like the Swiss franc's momentum has been broken, and it's at least a two-way bet now. Personally, I think the currency is so vastly overvalued that eventually something has to give. With Swiss interest rates now negative out to 10 years, perhaps we'll see more capital outflows from Swiss investors that will weaken the currency. The usual end-of-month data dump from Japan Friday showed that inflation there continued to decelerate and household spending dropped, even as the employment picture improved and industrial production finally picked up. Looks to me like Japan's finally getting an export-led bounce. This makes me think that the authorities are likely to see the weaker yen as perhaps their most successful policy achievement to date. The Bank of Japan won't want to lose the advantage that it's gained. I think we're likely to see a continued weak yen. As for today's highlights, during the European day, the main event's going to be the first estimate of Eurozone CPI for January. The fall of German CPI into deflation increased the likelihood that the bloc dips further into deflationary territory. This may keep the euro under selling pressure. In the U.S., the first estimate of GDP for the fourth quarter is expected to show that the U.S. economy expanded at a slower pace than in the third quarter. The first estimate of the core personal consumption index, the Fed's favorite inflation measure, is forecast to have eased from the third quarter. The market will also be paying attention today to the employment cost index, which is expected to accelerate a bit on a year-on-year basis. In contrast to the recent average earnings figure, that should reassure the Fed that compensation is rising along with improving employment conditions. We also have the Chicago PMI and the final U of M consumer sentiment for January. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.